Hello everyone. Today is going to be the 5th lesson of the Chart Engineer syllabus, and I'm going to discuss the theory behind price delivery. Price delivery comes in 4 different profiles. Profile 1, the consolidation. Profile 2, the expansion. Profile 3, the reversal. And Profile 4, the retracement. These 4 different types of market profile interchange with each other during the ups and downs following the flow of the marketplace. When price is consolidating, there's only one outcome that can occur after the consolidation, and that outcome is the expansion phase. So there's only one option that can happen after the consolidation. When price is expanding, we can expect 3 things to occur. 1, the consolidation, so price can either get back into a new consolidation. Price can get in a retracement, so price expands and then get into a retracement phase. And option 3 is reversal. The characteristics of a consolidation. Now I'm going to show you and explain what the characteristics of a consolidation are. Here you can see that price is moving sideways. And consolidation is when price is basically moving in a clear trading range and showing no willingness to move significantly higher or lower. It indicates that smart money is allowing orders to build on both sides of the marketplace. We can expect an expansion to happen near term. The characteristics of an expansion in a bullish scenario. So now I'm going to show you and explain you what the characteristics are of an expansion in a bullish scenario. Like I mentioned before, for price to expand, we need a consolidation beforehand. So here you can see how price is consolidating, and then now you can see how price is expanding higher. It basically indicates that smart money is delivering price to a higher level in this scenario. The characteristics of an expansion in a bearish scenario. Again, we need a consolidation to happen beforehand, and now you can see how price is consolidating, and out of this sudden you see that price is expanding lower, indicates that smart money is moving price to a lower level. The characteristics of a retracement. Here you can see that price is consolidating, price is moving away quickly, so this is the expansion, and now price is pulling back. And a retracement is nothing more than price coming back to pick up more orders and filling in inefficiencies that have been created during the expansion. So here price is pushing back up again. A little retracement again to pick up more orders, and then you can see how price is pushing back higher in the desired direction. In the blue shaded area, you see a fair value gap that has been created during the initial expansion, and you can see how price is coming back, filling in the inefficiency, picking up more orders, and then you can see how price is pushing back up higher again. The characteristics of a retracement in a bearish scenario. Here you can see how price is consolidating. Now you can see how price is expanding lower, leaving in all types of inefficiencies. And one of them are fair value gaps, which has been discussed in the previous video. And here you can see how price is retracing, and then price is expanding again. So this is a clear retracement that took place. And here again in the blue shade area, you see a fair value gap that has been filled in to the point. And in the gray shaded area, you see some form of resistance, order blocks, breaker zones, breakers, anything like that. The characteristics of a reversal in a bullish scenario. Here you can see how price is consolidating. Then you can see how price is expanding lower. Now you can see how price is reversing aggressively in the higher direction. So this is a bullish reversal. The characteristics of a reversal in a bearish scenario. Here you can see a clean consolidation, price moving sideways, showing no willingness to move higher or lower. Now you see price expanding higher, so a quick move away from the consolidation phase. And here a clean expansion lower, so basically the reversal. So price consolidating, expanding, and then basically expanding again in the opposite direction, which is called the reversal. Anticipating price delivery. As a trader, it's an essential skill to understand how you can anticipate the different types of price delivery. To anticipate price delivery, it's important to ask yourself 3 different questions, because these questions can help you guide through the thought process behind the anticipation of price delivery. Question number 1, where's price likely to go? To be able to answer this question, you have to have a good understanding of how market structure works. Question number 2, where's price now? And question number 3, where's the liquidity? And also for this question, you have to understand how liquidity works. Anticipating a retracement. I'm now going to show an example of how you can anticipate a retracement on the actual price chart. To do this, we are going to use the 3 questions that I just mentioned before to help ourselves guide us in the anticipation of the different types of price delivery. So question number 1, where's price likely to go? On the screen you can see a little price fractal, and you can already see the price is trending up, right? So let's mark that out. Here you can see the price at a high, a low, a higher low, and the higher high. You can even see that price took some liquidity here by forming the higher low, and we had a break and mark structure here and a break and mark structure here. So at this point we have a confirmed uptrend, and we can answer the first question. So where's price likely to go? Our price is likely to go higher, following the uptrend. Question number 2, where's price now? Price is currently sitting at the higher high, and in an uptrend we can expect a higher low to form. So the higher low could be the retracement. So we can already anticipate a retracement to happen in this case. And here you can see the projection that we can expect, so a higher low for a move higher following the uptrend. Question number 3, where's the liquidity? So in order to find out where the higher low could take place, we have to know where the liquidity resides. So now it's important to look for inefficiencies, where price could reach for to form a higher low and continue price in the direction of the previous expansion. So you can see here, price expanded higher. Now we are anticipating a higher low to form, and now we have to answer ourselves the 3rd question, where is the liquidity? Here you can see the fair value gap marked out, and fair value gap is basically nothing more than liquidity, because there are resting orders inside the inefficiencies. Now we can expect the retracement to take place. Price pushing lower, tapping the fair value gap, picking up some more orders, and then you can see our price pushing up. Again a little retracement here, and then price pushing up again, expanding higher in the anticipated direction. Anticipating a reversal. I'm now going to show you an example of how you can anticipate a reversal on the actual price chart. In this particular example, I'm going to use the H4 time frame and the M15 time frame. To help guiding ourselves anticipating certain price delivery, we are using the 3 questions again. Question number 1, where's price likely to go? So in this example, we can assume that price is in a downtrend. So the answer to this question is, price is likely to move lower, because we are in a downtrend. Question number 2, where's price now? Price is at this white candle right now, and we can see that there's not a lot of activity going on. In the liquidity video and the market structure video, we explained that price is likely going to manipulate in some way before going into the anticipated direction, and the anticipated direction is lower. So we had not a lot of activity here, and we can expect some kind of manipulation to occur. Question number 3, where is the liquidity? Liquidity resides above a swing high and below a swing low. In order for price to follow the downtrend, the institutional speculators demand the best possible position in the market. So at this point, we can anticipate the institutional speculators to manipulate price higher so they can position themselves properly. And here you can see how this looks like on the H4 time frame. But on the H4 time frame, there's not a lot of detail to frame setups. So I'm going to show you how this H4 price fractal looks like on the M50 time frame. Here you can see that price is consolidating. We already answered ourselves the 3 questions and we came to the conclusion that we can expect some kind of manipulation to take place. All we do now is watch the different types of price delivery and use the time and price concept that has been explained in the 3rd lesson of the Chart Engineer syllabus. So we can see the price is consolidating in a timed range, showing no willingness to move significantly higher or lower. We also see that the consolidation is taking place during the Asia session. So we can expect some kind of expansion to happen when the London session starts, because this is the time zone where the institutional speculators are active in the market. Price now expanding higher to take out the H4 liquidity pool. At this point, the institutional sell orders are being paired with the retail speculators their buy orders. Now that the institutional speculators got the sell orders filled, we can look for possible entry triggers to get in a position anticipating the reversal to take place. And here you can see how price is reversing lower. And in this reversal, when we zoom into a lower time frame, there are probably a lot of entry triggers that we can use in anticipation of the reversal. We can conclude that a reversal is usually nothing more than an AMD fractal that has been explained in detail in the 3rd lesson of the Chart Engineer syllabus. So here you can see the price accumulating, so basically consolidation. Here you can see an expansion. This expansion is the manipulation, and now you can see the distribution. And this entire move is basically the AMD fractal, and also a reversal. So in this lesson I went over the different types of price delivery and how you can anticipate certain price behavior.